Ramkrishna Forgings Limited, an listed entity with over 12,300 crore market cap and one of the leading forging players in India, had on 26th of April 2025 informed the stock exchanges about discrepancy in inventory, which was identified during the annual physical verification by the company. The company had appointed an independent external agency to look at it. The company followed up and submitted the joint fact-finding report to the stock exchanges. In this video, we will look at the report and look at the learnings from it for audit and finance professionals. Hi, I am Uday and this is Audit Insights. Before we get into the report, few very important disclaimers. Now, this presentation is intended for educational and professional training purpose only. The content is based exclusively on publicly available information filed by the company. It is not intended to be a commentary on the character, integrity, or competence of the company, management, or its board of directors. And this analysis and this commentary does not constitute a judgment on the work performed by either the company's statutory auditors, internal auditors, or the appointed consultants. To repeat, the focus is solely on looking at the documented findings to see what learnings that the audit and finance community can gather from it. Let's understand a bit more about the company so that we can understand the report and the context better. Now, Ramkrishna Forgings Limited is primarily engaged in manufacturing and sale of forged components, automobiles, railway wagons, coaches, etc. And it is in fact the second largest player in India in its space. So it has over 2,000 SKUs in auto components. Let's look at the sales and let's look at the finances of the company. The sales, if you see, has grown from 434 crores in March 2024 to 4,000 crores in 25. So in about 10 years, it has grown exponentially, right? So that's the sale. And even if you see the operating profit from 60 crores, it has grown to 558 crores. Again, an exponential growth. If we look at more from a balance sheet perspective, we can see, again, in this case, since we are interested in inventory, let us look at inventory from 157 crores in 2014 all the way to 1,254 crores in 25. That's again exponential growth. And when we look at some of the ratios, which is also important in this case, we can look at the inventory days had almost stayed stable with few periods of changes here and there, but it had almost been stable from 252 days to 229 days. Let's now get straight into the report. On 14th of June 2025, RK Ramkrishna Forgings had submitted this report to the NSE. I'll also be putting the link to this report in the video's description, wherein it basically said this report is a joint fact-finding report to understand and address the discrepancies in inventory balances and stock accounting. There were few external third parties who were appointed to do this activity, and the broad observations in the report covered few things about internal control and the internal control over inventory management. The company had also done a GST reconciliation, a bank statement analysis, a related party transaction, and physical verification, forensic imaging of devices, and interviews of custodians relating to SAP entries. So it looks like the company also wanted to probe the angle whether there were any manipulation or any fraud that was involved. That was probably also one of the ways of kind of looking at this kind of a difference. Now, what did this joint fact finding found out? The fact finding report confirmed that there were certain entries, erroneous entries or non-recording of rejections at plants, which resulted in overstatement of WIP, RM scrap as of March and as of 24 and 25. So it seems like the issue had been going on for some time now, the impact was big. So it was close to 6.73% of the net worth of the company for the year ended 31st of March 2025. So good 6 to 7% of the net worth were due to erroneous accounting or erroneous recording of inventory. I think it seems to be more like rejection, the accounting of rejections. Now the management had looked at the internal controls, looked at the processes, and they have mentioned that they have tightened the processes that they currently have to ensure that these kind of errors or issues does not recur. Let us look at some other key aspects of the fact finding report. Now the company had multiple plans. Yeah. So let's have a look at the scope, because it is scope and approach, because it is important for us also to understand how the company approached it, what were the best practices that we as finance and audit professionals can look at it. Now it basically started by examining the inventory records, right? Looked at what were the supporting documents that were kind of maintained. They had also reviewed the inventory management system and how the inventory was built up, meaning what were the POs, stock records, procurement requests for production, that is issue of material, and other relevant documents were examined. They also looked at adequacy and functioning of weigh bridges, because was it because of incorrect weighing that the stock had to be overvalued or was valued higher than what it was. So that was also probably one of the approach that the external fact finding auditors had. And they also looked at the documentation. They looked at the production process. I think one of the key important thing that generally the internal auditors, the financial internal auditors would not go in depth is on the BOM, which is a key aspect of inventory management. So studying the BOM or changes to the BOM and what are the related documents. Now BOM stands for bill of material. It basically gives the list of child parts. If a parent part is a finished good, what are the child parts that constitute the finished part? So that breakup is what is called as a bill of material. Now they also looked at the internal controls. They evaluated the effectiveness of existing controls, and fact finding potential suspicious activities such as theft or embezzlement. So they had also looked at a theft or embezzlement angle also. So whenever there are issues with inventory, whenever there are anything like short accounting, scrap, etc., the first thing that we as auditors or finance professionals would look at is basically theft. Was there a possibility of a theft? Was there a possibility of inventory getting siphoned off from the company's premises? So that's one of the key aspect to look at, and also could see to assess whether there were any unauthorized or suspicious payment to vendors or third parties. This was also a key aspect, because in the scope we also saw that they also looked at the bank statement. They also did some digital mapping of the employees' systems. So those were some of the steps that they had performed. Now this is a key aspect as to what they actually did, right? So first was a comprehensive wall-to-wall physical verification. Now, why is it such a big deal? Generally, if the organization is big, if the inventory godown is big, auditors, depending on the time availability, depending on the complexity, depending on the previous observations that they had, will not ordinarily do a wall-to-wall physical verification. They look at samples, they look at book to floor, floor to book, and they see what is the differences. If they are comfortable with it, they're okay with it. If not, they will do a detailed wall-to-wall physical verification. Now, in this case, they have done, it was obviously a big error. So they had performed a comprehensive wall-to-wall physical verification. They also implemented a 3-part card system. Now, what does it mean? So there are 3 parts. that are kept, one with the auditors, one with the item, meaning the material, and one with the one who will be basically doing the data entry and updates, etc. So this is one way of looking at it. It's not superly clear as to what kind of an approach they had, but this is one specific approach to three-part card system. In addition to it, there is also a triad reconciliation process, meaning three departments hold these inventory records saying that this location, this bin, this material code, this material description, this much of a quantity was there, and the unit of measurement. Is it in kgs or is it in numbers? The unit of measurement. So this is a bin. So this is what is generally kept along with the material, and this is basically signed by three different departments. In the card itself, they basically sign it to ensure that they have actually reviewed it. In some of the organizations, I could also see that they use a serial number for each of these cards. So each of the cards, what they have, they also put a serial number to it, so that there isn't a bogus entry or there isn't a card that was printed by someone else and used for the purpose of inventory verification. So they will have a card which will have a serial number also to it. So 3 cards, 3 different departments, having it, reconciling it, getting a comfort that whatever the reconciliation that is going in is basically what they had recorded. And stacking. So stacking is basically having the items sorted or arranged in rows and columns, and you basically multiply the rows and columns to get the total numbers. So it's basically easy for counting. So they have done that approach, and and select representative samples from stacked inventory to verify the count. Let's say that they have big boxes, and each box or each inventory bin or a box, say for example, contain, let's say 20 items, and the unit of measurement is in numbers. So I'm looking at 20 numbers. Now 20 numbers in one box, and we will have, let's say, 100 boxes. Now 100 into 20 is the total numbers. But how do we know that these boxes actually have 20? It could be that it's just an empty box, right? So to ensure that the boxes contain the material that the company claims to have, the auditor seems to have selected some of the items, some of the boxes, and checked whether the numbers that were supposed to be there are actually there. The inventory lying at third-party verification was also verified. This is something big in inventory management. Some of the organizations have this habit of saying it is in transit, it is in third party, but it would never exist there. So the auditor seems to have covered that. And then theoretical weights calculation and comparison. This is important whenever I think this organization has a lot of stock on metric tons, MTs, kgs. So it is possible that it is impossible to weigh the entire piece. So you basically take some sample, weigh it, and then extrapolate to the length or the volume or the surface area of the material that you have, and you basically extrapolate to get the total weight of material that we basically have. So this is an important piece as to how they have gone ahead with it, how they have approached this. I would recommend you to look at these, go through these in detail, because obviously there are a lot of disclaimers here in terms of what they have covered, what they have not. If you are interested in understanding this in detail, I would suggest you to go to that link, download the file, and then look at look at these things in detail. Let's look at the findings. Right, the numbers per se aren't so much of interest to us, because numbers are basically the impact, and we know that overall 6-7% impact is there, so it is significant. But when we look at the individual root causes, individual findings, that's when we probably get the learnings that we want from this. The first thing is erroneous entries made by users via different movement types. Now the ERP that is used by this organization is SAP. Now in SAP, there are very key movement types, 309, 310, which is basically reversal, which basically changes the material. So we are going to look at, right after this, we will look at some of the transaction codes which you should be monitoring when you are looking at inventory management in SAP. So basically 309, 310, very briefly, it basically converts material A to material B, the underlying quantity. Let's say material A has 10, material B has nothing. Just changing A to B will ensure that B gets this quantity. Now it's basically changing the material code, changing the description, or just adding. So these are very powerful features that one needs to be very, very careful of. The second one is the Z reports. In SAP, Z reports are kind of called as the custom reports. Now, whenever any organization uses a Z report, especially for the purpose of financial reporting, those are called as key reports. Now, key reports have to undergo additional detailed layer of testing, review, confirmation, UAT before those reports can be consumed for the purpose of financial reporting. In most of the organizations, the key reports are generally not tested. They are like these reports we are kind of using for long ago, so long ago, nobody knows how long ago. We continue to use the report and hence kind of no questions are asked. But what if the underlying logic is changed? What are the IT general controls ensuring that the reporting logic, the logic that is kind of configured within that Z custom report is not touched? So it is very important that organizations review the Z reports or custom reports to ensure that it is actually giving what it is. And if we are using any Z report or the custom report for the purpose of financial reporting, it has to go through a lot of review, approval, UAT like I mentioned, for any changes that has happened. Now in this case, there was a programming logic error. It seems to have been a programming logic error where there were multiple processes which involved the output was always 1:1. So input output ratio, they used to have only 1:1, but in this particular plant, it was not the case. So barring plant 7, all other plants had this logic, but plant 7 did not had this particular, the underlying process was not the same as the other plants. And for that reason, it has to be looked at it separately, but that did not happen. The third reason is the kerf loss, which is basically the burn loss. Now, what happens in metals is that you have that laser-like gas that is burning through the metal to cut the metal. Now, when we are cutting the metal, it is not like a paper where when I cut the metal, when I tear off the paper, the total volume of the paper almost remains the same. The loss that is due to the joints of that particular paper going off is very, very negligible. But that's not always the case for a metal. Now, plasma, which is here, plasma jets, it basically melts the metal, and high pressure gas, steam evaporates the molten metal. Now it is like I cut something and that volume that I am cutting is evaporated, meaning there is a reduction in inventory. There seems to have been issues in plant 7 with respect to that particular activity, which is also linked to the earlier Z reports. Maybe it is possible that Z report did not capture this underlying production loss. The fourth thing is there were certain unrecorded production losses because probably of the size variations. It again seems to have been from plant 8, where in addition to the plant size tolerances, they have got additional length width from the vendors. Now it happens both ways. There is a tolerance set by the quality team, which will basically say that I need X, say length and breadth, plus or minus say 5%, because it is possible that certain sheets will have the manufacturing dimensions will be of a certain length and breadth, so that only that can be supplied. So probably that is also a reason why there is a difference. Now the next thing what they have found is that it is the raw material found based on physical verification of previous years and entries made in current year without any effect on the corresponding SFG. SFG is meaning semi-finished goods. Now I have got the RM I have done the PV, I have got the differences, I have accounted for the differences, but it is just not RM. By the time I do the PV, it would have moved to SFG. So ideally there should have been a correction to SFG also for prior year physical verification differences, which was not followed. The next thing is material rejected as scraps but is available in block stock. In SAP, there is a workflow that ensures that a stock is blocked. A stock is blocked before pending any approval, any further activity that is to be done. For example, whenever there is a goods receipt, it is blocked for quality inspection. Only when the quality has completed the inspection, the stock will move from block stock to unrestricted stock. Till that point in time, that stock, it might be physically available, but it would not be used for dispatch or for giving it to production, because in the system, it will be there in the block stock. Similarly, the company seems to have established a five-tier approval process. Here it is, a five-tier approval mechanism for confirming the scrap. That's probably, some will say a lot, some will say a less, depending on the organizational complexity. One can look at it the way it is, right? So until and unless these 5 people probably approve it, it is not actually going to an unrestricted stock to be disposed of. So what the auditors found is that material was rejected in plant but was available in block stock, meaning that it was kind of rejected, but it was in the books, it was still there as a block stock, it was not moving. So that was also a key difference. So 1367 metric tons was missing, which may be due to physical transfer of such rejected materials by the company as excess scrap without giving corresponding effect in the SFG or the semi-finished goods of the organization. So we'll just come back to that. Yes, here it is. The next way in which they have found the difference is unrecorded destructive testing in heat treatment. So to test the quality of the material, they'll probably take some metals, they will do a destructive testing, maybe break it, fire it, burn it to see what are the properties of the metal, and those were probably, is allegedly not being recorded. Now, daily production reports. There was a mismatch, and I think one of the key takeaway from that is that there were post-dated entries which always creates problem. In SAP, generally if you do any post-dated entries, there are a lot of complexities involved, and SAP inventory is basically a complex module. Sometimes it will not give what you want if you do any post-dated entries. And another important aspect here, and if you are doing an inventory audit, you have to look out for this, is BOM routing is not available for SAP for process production booked under different mission number and production booked under different part number, resulting in wrong booking of production in SAP. Now, this routing is a critical aspect in SAP inventory. Now, what is BOM? What is routing? What is the difference between these two? BOM is basically bill of material, which will basically give, as I was mentioning before, it will give the breakup of what is the parent and child. Now, routing is basically the route that this item would take to be a SFG and RM. So routing would basically say this child part number will have to be worked upon or corrected or done for X number of hours or minutes in this particular mission, and the output is called as child 2. It could be an SFG, a semi-finished good. Now after this child 2, it has to spend X number of hours in mission 3, and that output is probably called as SFG 3. So like that, the RM will take different shapes of SFG from one mission and time to another mission and time. Finally, the production item would be ready. Now this route that the inventory takes from RM to SFG to FG is called as a routing. The SAP will basically book the production, the consumption based on the BOM and the routing and the level at which that particular material is there in the production process. So it is very, very important that this BOM and routing is clearly fixed. The next way in which they have found the issues with are scrapping and reversal via 551 and 552. If you look at the whole report, there were few key SAP movement types which they have identified, which was not adequately controlled, or the control around it were not adequate. Let us look at other things. I think inventory control, they had kind of looked at it. GST reconciliation, they did not find anything big. Bank statement analysis, they did not find anything big. Or related party transaction, they did not find anything big. I think, and then digital data analysis also, they did not find anything big. It was okay. There were no issues. I think one of the key things that we should look at it, and not for this organization, but for any organization that you are probably looking at, is why this has happened. So at the end of the day, it is human in the loop. It is humans sometimes are the challenge when we look at the risk and control place. Now, what was one of the key thing? It was lack of documentation during posting of special SAP movement entries. Now, what are these? We will look at it. And the senior leadership, they said, so that inability of the company to scale the SAP systems for stock maintenance and effectiveness of overall internal check. So the organization has grown phenomenally. We will look at some of the background of the organization, but the organization has grown phenomenally, and that's probably the reason why the SAP system could not be kept up. Now, protocols were not, the access protocols were not well defined, which in turn lacks the ability to define proper accountability. It is probable that they might have, generic user IDs, probably, right? I mean, shifts, the same ID will be used by multiple shifts or multiple people. Probably one of the reasons that they had to make the statement, but there could be anything else also as well. But one of the key issues that we find in inventory related stuff is access control, because if it's a generic ID, all stores, maybe they'll have 3 IDs, one for entry, one for approval, one for reports, and every person in that particular organization who's in stores, let's say stores have 10 people, everyone would be using these accesses interchangeably, and that's always a challenge. And then rapid growth of the organization, weaknesses were noted around timely recording of production entries in SAP. So I think these were, I think Z report is something that was highlighted, and there were quite a few SKUs, the number of unique units, the part numbers, so 2000 different unique part numbers. That's huge, but that's probably what is there in a manufacturing setup, and there is always an opportunity to refine it. There were delay in recording, and they were not, and then custodians that they are not authorized to make backdated entries directly, and there is an IT department involvement is also there, but they seem to have made it. And there, of course, we will look at the SAP movement times. No, movement type. So this seems to have been, so this is the summary of what we can see from the report. In the next part, we will look at some of the learnings that we have already seen, but we will try to summarize those learnings and also look at some of the key movement types that you should look at when you are doing an inventory audit. As we have seen in the report, let's summarize what had happened, the root causes, and what are the learnings. The first root cause that we could see from the report is the misuse of SAP transactions. So there were erroneous entries that were made by users via specific movement types. The second key reason that was highlighted in the report was the flawed custom logic, because there was some Z report, which was basically a custom report, that did not get it right. The third key reason was operational blind spots. It seems to have been, there seems to have been failure to record known process loss like scrap and testing materials in SAP, like the burnt loss that we saw, probably those were not recorded. And lack of documentation, verbal approvals, those were kind of mentioned in the report. Probably some of the key learnings, and that's the objective of this, is monitor the special transaction codes in SAP. We will look at some of the SAP transaction codes that should be there, and as a finance and an audit professional, we need to advocate for no documentation, no transaction policy. So we should be the torchbearers of that. Second one is physical verification of scrap. I know that some of you would be thinking that it is very, very easy to say. Yes, it is difficult, but at some point in time, it has to be done so that our records are clean. And let's give it. During the manufacturing process, it is possible that things will go haywire. They just want to get the product out. So there will be lot of, commotion, lot of stuff to do. It is possible that it is not actually being done as per the process, but at some point in time we need to step back and look at it, and then do these kind of verification in detail. And the third important aspect, and as finance and internal audit professionals, it's again a bit not the regular thing that we do, is go through the production process. Go through the production process. I have seen the younger generation now don't want to go to the shop floor, but shop floor is where the activities are happening. Go to the shop floor, look at what is happening, look at what we are accounting, and look at how we can do that better. The next one is periodic review of BOM and routing data. Now don't take it off like, oh, it's a technical review, what am I going to do it? But just see, visually inspect and see if what we are recording makes sense or not. Is it not having a process loss? Is there anything? So if the BOM routing does not have a process loss, but you are seeing some scrap getting generated, that's a trigger point for you to ask that question as to why is this not getting accounted? What are the number of stages that are there? That's the routing that are there versus what is being recorded in BOM. These are the questions that you can ask. The next thing is Z reports. Now any custom report, if you are using it for financial reporting, like I had mentioned before, it is important that gets through a thorough testing. Now this input-output ratio is a very, very critical aspect in any manufacturing setup. For X input, Y would be the output. It could be in terms of numbers, it could be in terms of weightage. It is important that we understand that it cannot be 100% right. It is possible that it is not 100% right, but if you look at the trend over a period of time, you will understand that there is an average number that will come out that will be more kind of comfortable for us. So the last thing here is if ERP is commensurate with the operational complexity and size, because like you had seen before, some of the comments from the independent fact-finding auditors were that it has grown too big and there were verbal approvals that were in place. So those needs to be taken care of when we are maybe selecting an ERP or going for an upgrade of an ERP. Those aspects needs to be covered. Now what are some of the key transactions that you should look at? Now there are these 5 series transaction codes, which is 501. See, any 1 and 2 is basically placing it and reversing it. So 501, 502, 503, 504, 505, 506, etc. Right? So this is 501. So if we look at purchase order, meaning the goods receipt without a PO, meaning that without a PO, if they can just ad hocly insert a GRN. Now those are things that you should be careful of. Should be looking at 501. I'll be putting the link to this deck in the group description. 503. 501, 502, 503, which is like with into quality inspection stock, but goods receipt without a PO, and this is going straight into unrestricted use stock. 505 into block stock. 505, 21, 23, 25, which basically gives GRN, which is FG without a production order. The other key adjustments that you should be looking at are basically the inventory adjustments and write-offs, and this is also very critical, are 551, 553, 555, and then 701, 702. Any entries under these special transaction codes needs to have a documented approval. There are few more. So this is the 300 series. I think this is 310, 310 is something that was mentioned in the report as well. We have this 309, 321, 322, and then 343, 344. These are transactions which can change the nature of material, change the nature of inventory, and it is important that we look at it. And this is generally, you will not find these kind of entries in a kind of an organization which is running, which is kind of already up and running. But at the time of initial upload, these are some of the transaction codes that will be used to upload the initial stock balances. Now be very, very careful about these Z movement types. I do see in some organizations which have complex processes do use Z movement types. Very rare, I don't see it often, but it is possible that there are certain Z movement types. Any of the Z movement types, if you look at the ABAP coding behind it, you will look at it is probably calling a standard movement type to place that order. But be very, very wary of what it is, how it is, do a testing, understand the documentation, and get the comfort. Hope you had found this video useful. Thank you.